Imagine for a moment having a crystal ball, one that could, reveal the intricate workings of the global energy market.
Yeah, wouldn't that be something?
Not just where we are right now, but the trajectory of the world's energy needs and, crucially, who is actively powering that future. Today, we're going to try and get as close to that as possible, embarking on a deep dive into the very real, very massive operations of a company that is quite literally drilling into the future of energy.
That's a very apt way to put it. We're talking about a company whose name you might not hear every day in the headlines, maybe, but their impact on the global energy landscape is, well, it's undeniable.
Absolutely.
We're shining our spotlight today on Valaris Limited, a true powerhouse and a leading name in offshore drilling services. Their fleet of massive rigs operates like silent giants, sculpting the very bedrock of our energy infrastructure beneath the oceans, undeniably driving how energy reaches us every single day.
And our mission today is to pull back the curtain on this vital industry player. We've gathered an incredible stack of sources for this deep dive. We've got their latest fleet status report from April 2025, their first quarter 2025 earnings results, a full transcript of their Q1 2025 earnings call, and their June 2025 investor presentation.
Yeah, quite the pile.
These aren't just dry documents, right? They are a treasure trove of information about a company that is really at the cutting edge of energy extraction.
And our goal is simple, really. To unpack these documents, to extract the most important nuggets of knowledge and insight, and to reveal how Valaris isn't just reacting to the dynamic energy world, but is actively driving it forward.
Okay.
We'll explore the impressive scale and capabilities of their fleet, their strategic contract wins that secure future operations, their robust financial health, and what all of this means for the global energy picture at large.
So prepare for some truly fascinating insights. Maybe a few surprising facts about the intricate world of offshore drilling, and most importantly, a shortcut to being incredibly well-informed about a critical sector of the global economy.
That's the idea.
By the end of this deep dive, you're going to have a clear, comprehensive picture of Valaris's robust operations and their absolutely pivotal role in meeting the world's ongoing and future energy demands. Let's unpack this.
Let's do it.
So to kick things off, let's establish a foundational understanding of Valaris. Who are they, really?
Yeah.
Beyond the name, what's their core identity in the vast world of energy?
Well, Valaris truly stands out as an industry leader in offshore drilling services. Their core identity is centered on providing comprehensive drilling solutions across all water depths and geographies.
All depths, all geographies.
Yeah, exactly. This isn't just a regional player. They boast a significant presence in nearly every major offshore basin around the globe. Think of them as the go-to experts for extracting resources from beneath the world's oceans, no matter how challenging the environment or how deep the water.
Okay.
They are like the essential link between vast subsea reserves and the world's energy needs.
And when you say significant presence, my mind immediately goes to the sheer scale required for global operations. What does that actually look like in terms of their physical assets? I'm curious about the kind of operational footprint a company like this needs to truly dominate the global offshore drilling landscape.
That's an excellent point. As of April 30, 2025, Valaris operates an impressive fleet of 49 rigs.
49, wow.
Yeah, that's a substantial number, and it's important to break down what those rigs are. It includes 15 high-specification floaters, which are advanced drill ships and semi-submersibles designed for deep and ultra-deep water operations.
Okay, the floaters for deep water.
Right. And in addition to that, they have 34 modern shallow water jackups.
34 jackup.
This diversified fleet allows them to serve a wide range of customer needs, from the most complex multi-year deepwater projects to more routine but equally critical shallow water developments. The scale isn't just about size, it's about unparalleled operational flexibility and reach.
So they clearly have the hardware, the fleet to operate globally. But what about their long-term objectives? What is the overarching strategy that guides such a massive operation in an industry known for its cycles? It can be pretty boom and bust, right?
It can be, yeah. And their strategic vision is crystal clear: to be the first choice for customers, employees, and investors alike.
First choice for everyone.
That's the goal. They aim to achieve this by consistently delivering safe and efficient operations with their scaled, high-quality fleet. The ultimate goal, of course, is to maximize value throughout various economic cycles.
Okay.
This isn't merely about drilling for drilling's sake. It's about strategic partnerships, long-term vision, and ensuring sustainability in a highly cyclical industry. The key insight here is that their ability to deliver consistently high performance makes them a preferred partner, securing long-term contracts and enduring relationships, which translates directly into stable revenue streams.
That focus on safe and efficient operations is a recurring and vital theme in this industry. Can we dive a little deeper into what that means in practice? Do they have specific metrics that truly showcase this operational excellence, something that sets them apart?
Absolutely. And one of the most telling metrics of their operational excellence is their revenue efficiency. Valaris has maintained an incredible 96% or higher revenue efficiency for 4 consecutive years.
96% plus
Yeah.
for 4 years.
Yeah, 4 years straight. For listeners, what this means is that their rigs are consistently earning revenue for 96% or more of the time they are available, compared to their maximum potential.
Wow.
This indicates exceptional operational uptime, minimal idle periods, and very reliable performance for their customers. The key insight here is that this level of consistent efficiency isn't just a number, it's a profound competitive advantage that makes Valaris a preferred partner, saving their clients immense time and money on complex, high-stakes projects.
Right. Uptime is money in this business.
It really is. It speaks volumes about the robustness of their maintenance programs and the skill of their crews.
That's a remarkable number, especially over such a long period. It truly speaks to their consistency. But in this industry, beyond efficiency, safety is paramount. I mean, you hear horror stories. How does Valaris stack up on that front, and what kind of impact does that have?
Well, their commitment to safety is unwavering and truly exemplary. In 2024, Valaris achieved a safety performance that was more than 50% better than the offshore peer group average.
50% better.
Yeah. To put that into perspective, their lost time incident rate, or LTIR, was a remarkable 0.04 compared to the International Association of Drilling Contractors, or IADC, offshore peer group average of 0.09.
So less than half the incident rate of their peers.
Pretty much. These aren't just abstract numbers, they represent tangible successes in preventing incidents and protecting their workforce, which is an enormous responsibility given the nature of their work. This translates directly into fewer delays, reduced costs from incidents, and greater peace of mind for their customers.
That's impressive to hear about their safety metrics. Numbers are one thing, but sometimes it's the stories or specific achievements that truly bring it to life. Did the earnings call provide any tangible examples or anecdotes that demonstrate this commitment on the ground? Like rig-level stuff?
Certainly. Yeah, on the earnings call, several specific rig achievements were highlighted, which really underscore this dedication. For instance, the Valaris 121 achieved 2 years without a recordable incident.
2 years, recordable free.
Exactly. And the Valaris 144 and the Mad Dog platform each marked 1 year recordable free. These aren't just statistics. They represent thousands of hours of dedicated effort, meticulous planning, and strict adherence to safety protocols by their on-site teams.
That's huge commitment.
It's a testament to a culture deeply ingrained in their operations, where every single person on the rig is committed to returning home safely at the end of their hitch.
And has this commitment to safety garnered any external recognition or awards? That would certainly validate their claims, wouldn't it?
Indeed, Valaris has received significant external validation for their safety prowess. They were awarded the 2024 Best Safety Performance Award for jackup rigs from the IADC North Sea chapter.
Okay.
Furthermore, they received the prestigious Safety Leadership Award in both 2023 and 2024. This consistent recognition from industry bodies like IADC and the Center for Offshore Safety highlights that their commitment to safety is not just an internal goal, but is also acknowledged and celebrated across the industry as a benchmark for excellence. It really sets them apart as a leader.
So we've established Valaris' identity, their impressive fleet, and their unwavering commitment to operational excellence and safety, which truly sets them apart. Now let's see how all this excellence translates into their financial performance.
Right.
What were the key highlights from their first quarter 2025 results? How did the numbers look?
Well, the first quarter of 2025 showed robust financial performance. Their adjusted EBITDA saw a significant jump, rising to $181 million from $142 million in the fourth quarter of 2024.
That's a pretty big leap quarter over quarter. What drove that?
This improvement was primarily driven by more operating days for their rigs and higher average daily revenue, particularly within their floater fleet. What this tells us is that their high-value assets are increasingly active and operating under favorable market conditions, directly boosting their profitability.
And how did that strong operational activity translate into overall revenue for the quarter? Did that follow suit?
It did. Revenues, exclusive of reimbursable items, also saw a healthy increase, rising to $578 million in Q1 2025 from $548 million in the previous quarter.
Okay.
This reinforces the point about increased operational activity and effective contract management. They're clearly seeing the financial benefits of a busy and robust market for their services.
That's certainly positive on the revenue side.
Mm-hmm.
What about their ability to generate actual cash? That's always a crucial metric for any company, maybe the most crucial.
Yeah, absolutely. They generated $74 million in adjusted free cash flow during Q1. This is a strong indicator of their financial health and liquidity, demonstrating their ability to convert their operations into deployable cash after accounting for capital expenditures.
So cash in the bank after paying the bills.
Essentially, yeah. This consistent cash generation ability is crucial for future investments, fleet modernization, and, importantly, shareholder returns.
Now, I noticed in the reports, and you might need to clarify this, a reported net loss of $39 million for Q1 2025. Could you help our listeners understand that in context, as it seems to contrast with the positive numbers you just mentioned? It can be a bit confusing, right?
That's a very important point for context, and it's a great question to clarify. It does look odd at first glance. While a net loss of $39 million was reported, it included a significant non-cash discrete tax expense of $167 million.
Okay, a tax item. What was that about?
This specific tax expense was primarily due to the establishment of a valuation allowance on deferred tax assets. This was a direct result of their strategic decision to retire 3 older semi-submersibles during the quarter.
Ah, so tied to retiring those rigs we mentioned earlier.
Exactly. When you adjust for these discrete, non-operational items, their net income was actually a positive $128 million.
So 128 million positive, adjusted.
Correct. So it wasn't an operational loss stemming from poor performance, but rather an accounting adjustment related to a strategic fleet optimization move. It gives a much more complete and positive picture of their underlying financial performance. It's a key distinction to make.
That certainly clarifies the financial picture, not a performance issue, but strategic reevaluation of assets. And speaking of those assets, let's talk more about the fleet itself. We touched on its size and composition, but what truly makes their rigs so impressive, especially the high-specification fleet? I mean, what does seventh-generation drill ship actually mean for those of us who aren't experts in deepwater drilling? What's the big deal?
That's an excellent question, and it's where Valaris truly shines. When we talk about Valaris's high-specification fleet, particularly their 7th-generation drill ships, we're discussing the elite of offshore drilling, the Ferraris of the rig world, maybe.
Okay, the top tier.
Right. Out of Valaris's 13 drill ships, a remarkable 12 are 7th-generation assets. This positions them incredibly strongly for complex, long-term deepwater projects because these rigs possess cutting-edge technical capabilities that deliver significant efficiencies and reliability for their customers. These are not just bigger rigs, they are fundamentally more advanced and capable machines.
So it's not just the label. What are these specific technical advantages? Why does a 7th-generation rig matter so much to a customer beyond simply being new? What can it do?
Well, the technical advantages are substantial and directly impact project efficiency, safety, and ultimately cost savings for the client. First, they feature dual derricks with high hook load capacity.
Dual derricks, like 2 cranes.
Sort of, yeah. Dual derricks enable simultaneous operations. Think of it like this. Instead of a single chef in the kitchen meticulously preparing one dish at a time, you've got 2 highly synchronized chefs working on different parts of the meal simultaneously.
Ah, okay. Faster.
It just speeds everything up dramatically, reducing project time and costs for customers. And with a 2.5 million pound hook load capacity, these rigs can handle much heavier loads, allowing them to drill deeper, more complex wells than older generations, accessing reserves previously out of reach.
That sounds like a game changer for speed and depth, truly pushing the boundaries. What other features are key to their superior performance?
Another critical feature is their high-capacity thrusters. These rigs are equipped with 6 5+ megawatt thrusters.
Thrusters, like on a spaceship.
Huh? Yeah, kind of. What this means in practical terms is that they can maintain better station keeping, even in the most challenging ocean conditions. In deepwater drilling, precision is absolutely crucial, and these powerful thrusters ensure the rig stays exactly where it needs to be for precise operations.
So it stays put, even in rough seas.
Exactly. Then there are the dual blowout preventers, or BOPs. Having two BOPs provides a huge advantage. It significantly reduces what's known as flat time between wells, essentially, the non-productive time spent preparing for the next phase.
Less downtime between wells.
Right. And more importantly, it offers crucial redundancy in case an unplanned pull of the BOP stack is needed, which is a direct contribution to safety and efficiency. It's about building in layers of protection and operational continuity.
So it's about doing more, faster, and safer, even in extreme conditions. And what about the actual depth they can reach? How far down can these cutting-edge machines go?
Precisely. These seventh-generation drill ships are capable of drilling in water depths of 10,000 feet or more.
10,000 feet. That's almost 2 miles down.
Yeah, it's incredible. This enables them to operate in the most demanding, ultra-deepwater environments, where many of the world's largest untapped hydrocarbon reserves are found. These advanced capabilities are why customers overwhelmingly prefer these assets for longer-term developments, especially for multi-well programs, because the amplified efficiencies truly add up over time, yielding significant economic benefits.
Makes sense.
It's not just about what a rig can do, but what it enables the customer to achieve more effectively and economically, unlocking new energy frontiers.
Beyond the giants of the deep, Valaris also operates a significant jackup fleet. What's their role, and how do they contribute to the company's overall performance and strategy? They're not quite as glamorous, maybe, but still important.
Oh, definitely still important. The jackup fleet is incredibly versatile and contributes significantly to Valaris's financial performance. These rigs are designed for shallower water markets and can be broadly categorized. They have harsh environment jackups, which operate in more extreme conditions, like the North Sea.
Right, tougher conditions.
And benign environment jackups for calmer waters. They also have a substantial number of rigs leased to ARO Drilling, their joint venture in Saudi Arabia.
The ARO partnership.
Yeah. This segmentation allows them to serve diverse market needs and maintain a strong presence across different operational envelopes, ensuring a broad and robust revenue base. They're the workhorses of the shallow water.
It sounds like a well-oiled machine, but market conditions are constantly evolving, as we said. How does Valaris manage its massive fleet to remain agile and efficient, particularly when rigs aren't actively under contract? Do they just sit there costing money?
No, they employ what they call prudent fleet management, which is a really proactive and intelligent approach. This involves actively managing costs for rigs that might experience idle time between contracts.
Okay, how do they do that?
A great example is the Valaris DS-12 drill ship. After completing its contract in Egypt in March, it was strategically moved to Las Palmas, Spain. This wasn't just a relocation, it was a proactive move to reduce costs while the rig awaits its next contract.
So they park it somewhere cheaper.
Essentially, yeah. The insight here is that they're not just waiting for the next job. They're actively optimizing their asset utilization and minimizing expenses even during non-operational periods, which protects their margins. It's about smart logistics.
And what about rigs that are no longer economically viable? Do they hold on to them, hoping for a market rebound, or do they make difficult but strategic decisions? You mentioned those 3 semi-submersibles earlier.
They're very decisive on that front. Prudent fleet management also includes strategic divestitures, that is, retiring rigs when their expected economic benefit no longer justifies the ongoing operational and maintenance costs.
Cutting their losses, basically.
You could say that, but it's more strategic. In April 2025, Valaris sold 3 older semi-submersibles, the Valaris DPS-3, DPS-5, and DPS-6 for recycling. This wasn't just a sale, it was a permanent removal from the global drilling fleet, taking less competitive rigs out of the market.
Okay, so they're gone for good.
Exactly. This strategic move helps them maintain a high-quality, efficient fleet and optimizes their cash flow by eliminating expenses associated with older, less competitive assets. They also sold the jackup Valaris 75, which further contributed to their cash flow from asset sales. It's about optimizing their portfolio for maximum long-term value and maintaining a competitive edge.
This sounds like a company that's not just sitting back, but actively shaping its future through these strategic decisions. And the most tangible evidence of that has to be their contract wins. Tell us about the recent record-breaking backlog growth. What does this signal for Valaris? That sounded huge.
The numbers here are truly impressive, and they signal immense commercial momentum. Valaris secured approximately $1.0 billion in new contracts and extensions since February 18, 2025.
$1 billion in just a few months.
Yeah, it's massive. This wasn't just a minor bump. It boosted their total contract backlog to an impressive $4.2 billion, up from $3.6 billion previously. That's a nearly 20% increase in backlog in just a few months. What this tells us is that demand for their services is robust, and their commercial team is highly effective at securing valuable, long-term work, giving them significant revenue visibility for years to come.
And where did this massive increase in backlog come from? Was it all from one type of rig like those fancy 7th-gen ships? Or was it a balanced effort reflecting the diversity of their fleet?
It was actually a balanced success story, which speaks to the versatility and market demand for their entire fleet. Approximately $400 million of that backlog came from their floater fleet.
Okay, the Deepwater rigs.
Right, which includes the drill ships and semi-submersibles. The other $600 million came from their jacked-up fleet, highlighting their success across both deep and shallow water segments.
So strengths across the board.
Exactly. This balanced growth shows that their strategy of maintaining a diversified, high-quality fleet is paying off across the board.
Let's zoom in on those floater contracts, particularly the high-value Deepwater wins. What stands out as a key strategic move for Valaris in this segment? Was there one really big one?
Well, the most significant floater contract award recently is for the drillship Valaris DS-10 offshore West Africa. This is a substantial 2-year contract expected to commence late in Q2 or Q3 2026.
2 years, starting 2026. What's the value?
The firm term of this contract alone is valued at an impressive $352 million. And that's just the baseline. It excludes additional services or managed pressure drilling or MPD rates, meaning the true value could be even higher.
Over $350 million.
Yeah. Plus, it includes 2 unpriced 1-year options, extending potential work even further. What this significant figure tells us is the sheer scale of commitment Valaris is securing for its high-spec rigs, reflecting the strong demand and premium pricing they can command.
That's a truly significant contract.
Well,
What's the strategic impact of this specific win for Valaris, beyond just the immediate revenue? Does it set them up for more work in that region?
oh, absolutely. This contract significantly enhances Valaris's presence and strong reputation in West Africa, which is a key deepwater market with enormous future potential.
A foothold in a hot market.
Yeah, exactly. They see further long-term opportunities in this region for 2026-2027, and this award reaffirms customer preference for established drilling contractors like Valaris, who can provide high-spec rigs with advanced technology and reliably deliver complex offshore programs. It's more than just a job. It's a strategic foothold that can lead to further long-term work and strengthen their market leadership in a critical global basin.
And what about other drill ships? Any other notable engagements or extensions that illustrate their deepwater dominance globally, keeping those big rigs busy?
Yes, there are several others illustrating their continued deepwater dominance. ExxonMobil, for example, exercised a 6-month priced option for the drillship Valaris DS-9, which will commence in January 2026, directly after its existing program.
Okay, continuity there.
Right. This rig also provides MPD services and is expected to return to Angola in Q3 2025. Other key contracts include the Valaris DS-16 in the U.S. Gulf, which comes with MPD and additional services, and a 1-year option showing continued high-value work in that key basin.
Gulf of Mexico still strong.
Definitely. The Valaris DS-15 is in Brazil at a premium day rate, around $400 say a day, also with MPD and additional services. And the Valaris DS-4, also in Brazil, commands a very strong day rate, $450K, plus significant mobilization fees, again, including MPD and additional services.
Wow, those day rates are high.
They are. These are all high-value contracts that underscore their strong position in premium deepwater markets, securing work for their most advanced assets.
It's clear they're making big waves in deep water. What about their shallow water jackup fleet? How is their contracting success looking there? And are there any partnerships that are particularly important? You mentioned ARO earlier.
Yeah, their jackup segment has seen significant and strategically important wins, particularly through that partnership with ARO Drilling in Saudi Arabia. 5 jackups, Valaris 116, 140, 141, 146, and 250, which are leased to ARO, received 5-year bareboat charter extension.
5 rigs, 5 years each.
That's right. For listeners, a bareboat charter means Valaris leases the rig to ARO without providing a crew, essentially a long-term fixed revenue lease. This ensures their operations offshore ARO. Saudi Arabia will continue all the way into 2030 for these specific rigs.
Into 2030. That's incredible long-term stability.
It really is. And a predictable revenue stream for Valaris.
How important is this ARO drilling partnership for Valaris's overall strategy? It seems pretty core.
It's absolutely crucial. ARO drilling is an integral part of Saudi Aramco's infrastructure, and this partnership provides Valaris with a stable, long-term revenue stream from a key global energy producer. It's a testament to the strong relationships they build and their ability to secure enduring partnerships in critical markets.
Makes sense.
It's worth noting that two of these rigs, Valaris 116 and 250, have planned out-of-service periods for special periodic surveys and major equipment recertifications, about 6 months each from October 2025 to March 2026.
Oh.
But these periods are built into the 5-year charter duration, so it doesn't impact the overall stability of the revenue stream.
Planned maintenance, okay.
Right. After these extensions, Valaris will have only one rig offshore Saudi Arabia with availability in 2027, with the remaining 6 contracted into 2030, showing deep, long-term coverage in a high-demand region.
Beyond Saudi Arabia, where else are the jackups seeing success, perhaps in more niche yet attractive markets?
They're successfully expanding their footprint in attractive niche markets. In Trinidad, for example, Valaris secured a 545-day contract for Valaris 117 starting in Q3 2026 at a day rate in line with regional market rates with a 185-day priced option.
Growing in Trinidad.
Yeah, this will grow their Trinidad footprint to 3 jackups, reinforcing their scaled positions there. The Valaris 118 also recently drilled a successful exploration well at the Frangipani field, highlighting Trinidad's renewed focus on boosting gas production, creating more opportunities.
Good news for them there. And Australia.
In Australia, Esso exercised a 180-day priced option for Valaris 107, continuing its program from November 2025. These are examples of how they leverage their existing presence and reputation to secure additional work in these specific strong markets.
And what about closer to home for some listeners in the North Sea? How's that market shaping up for their jackup fleet? It can be a tough market, right?
It can be. In the North Sea, Valaris secured a 730-day contract for Valaris 248, commencing in November 2025, adding 2 years of work there.
2 more years locked in.
Exactly. They're also seeing increasing customer demand in this region for plug and abandonment or P&A work, and even new energy projects, areas where Valaris rigs are very well positioned to meet that evolving demand.
So opportunities beyond just drilling new wells.
Precisely. It's a dynamic market, and their specialized harsh environment rigs are well suited for its unique challenges and these new opportunities beyond traditional drilling.
So Valaris clearly has its operational house in order and a strong contract book. Now let's zoom out again. If we're truly peering into that crystal ball of global energy, where do Valaris and offshore production fit into the bigger picture? How do they see their role, and the role of offshore production generally, in the context of the global energy landscape?
Well, Valaris firmly believes, and the data seems to support this, that offshore production will continue to play a vital role in meeting the world's energy needs for the foreseeable future.
Still vital, even with the energy transition conversation.
Yes. And specifically, deepwater projects hold a particularly attractive and strategic position in that landscape. This isn't just wishful thinking, it's based on compelling economic and environmental factors.
Why Deepwater in particular? What makes it so compelling compared to other sources of energy, especially as the world transitions? Is it cleaner? Cheaper?
It's a combination. Deepwater offers a unique set of advantages that are increasingly valued. It holds large and highly accessible resource potential, meaning there are vast amounts of hydrocarbons waiting to be unlocked with significant reserves already discovered.
Big pools of oil and gas.
Exactly. The project economics are compelling, even at lower commodity prices, as we'll see. And critically, from an environmental perspective, deepwater projects often have comparatively low carbon emissions intensity factors throughout their life cycle.
Lower emissions intensity.
Yeah, compared to some other production sources, like certain onshore or unconventional plays. This combination of factors, scale, economics, and relatively lower carbon footprint ensures its continued relevance as a stable and efficient energy source.
That's a powerful argument. Do we have any data to back up these compelling economics, especially in a world that's sensitive to energy price fluctuations? Like, how cheap does oil need to be for these projects to work?
We do, and it's a surprising fact from Rystad, a leading energy intelligence firm. Approximately 70% of deepwater programs expected to be sanctioned, basically, given the green light over the next 3 years, have break-even prices below $50 per barrel equivalent.
Below $50 a barrel.
Yeah. If you compare that to the current 5-year forward price for oil, which is comfortably in the mid-$60 per barrel range, you can see the inherent economic resilience of these projects.
That's a big cushion.
It is. The insight here is critical. Deepwater isn't just about massive scale. It's proving to be one of the most economically robust and surprisingly adaptable sectors in energy, offering a strong buffer against price volatility and ensuring its long-term viability even as global energy markets shift. This resilience means these projects are likely to move forward regardless of minor market fluctuations.
That provides a clear picture of economic stability for Deepwater. What about future drilling activity? Are there any forward indicators we should be looking at that signal continued growth for the industry, like leading indicators?
Absolutely. One strong indicator is the trend in subsea tree installations. These are critical pieces of equipment required after development drilling has taken place to bring oil and gas to the surface.
Okay, the hardware that comes after the drilling.
Exactly. Projections show that subsea tree installations are expected to be over 40% higher on average in 2026-2028 compared to 2024-2025.
40% higher? That's a lot.
It is. This signals near-term growth in drilling activity as the equipment needed for production is being installed at a faster pace, implying that the wells have already been or are about to be drilled. This trend also includes meaningful growth for approvals of greenfield development, that's brand new fields and exploration projects, which is a very positive sign for the longevity of the current upcycle in offshore drilling, pointing to sustained demand beyond just existing fields.
So a healthy outlook for Deepwater with tangible indicators. Let's talk more about the floater market specifically. Where is the demand heading, and what are the key regional hotspots that Valaris is targeting? Where's the action?
Well, overall benign environment floater demand, so not the harsh North Sea type stuff, is anticipated to increase by about 10% on average in 2026-2028 compared to 2024-2025.
10% growth. Where's that coming from mainly?
The growth is expected to be primarily driven by South America, specifically Guyana and Suriname, Africa, including Nigeria, Ivory Coast, and Mozambique, and also some Southeast Asian areas like Indonesia. These are the regions where the big multi-year deepwater projects are concentrated and where Valaris' 7th-gen drill ships are in high demand, the so-called Golden Triangle plus Asia.
And within Africa, are there particular areas or projects that stand out as significant drivers for floater demand? You mentioned West Africa earlier with that big contract.
Yeah, West Africa remains the most active area for future floater opportunities, with about 10 long-term programs expected to start in 2026 or 2027. These include significant projects offshore Nigeria, Ivory Coast, and Mozambique.
Any specific big ones to watch?
Well, for example, Eni's Coral North project in Mozambique is pending final investment decision approval, and Total Energies is progressing its development plan for the Venus project offshore Namibia, which alone could generate between 6 to 8 rig years of work for ultra-deepwater drill ships like Valaris's.
6 to 8 years of work from one project.
Potentially, yeah. These are concrete drivers of long-term, high-value demand in that region.
Brazil is always a big player in offshore energy, often described as a mega basin. What's the outlook there for floaters, especially with Petrobras, the national oil company?
Brazil continues to be the largest market for benign environment floaters globally. Petrobras's rig count is expected to remain stable in the near to medium term, indicating consistent work.
Stable demand from the biggest player.
Right. They've issued a new multi-year tender for the Búzios field, targeting one or more high-specification rigs for work starting in late 2026 or early 2027. We also expect Petrobras to issue another tender later this year, which, combined with the Búzios tender, should extend work scopes for several rigs offshore Brazil to the end of the decade.
So locking in work through 2030, potentially.
That's the expectation. Additionally, Shell's Gato do Mato project recently received its final investment decision approval, adding to the demand in this key market. The sheer scale of Brazilian deepwater projects provides a consistent backbone of demand.
Any other South American hotspots beyond Brazil and the established regions like Guyana?
Yes, there's growing demand potential in Suriname given its proximity to Guyana. We've recently seen multi-year contract awards there, indicating this region is becoming increasingly active and a new frontier for deep water exploration and development.
Suriname is heating up.
It seems so. As for Egypt, activity has picked up significantly due to exploration success, partially by Valaris drill ships themselves, actually, and regulatory reforms to streamline licensing. There's one tender currently in process, and discussions suggest additional contracting opportunities are under consideration, showing a rejuvenated market there.
And outside the Golden Triangle regions of the Americas and West Africa, are there other pockets of significant deepwater opportunity? Maybe Asia?
Indeed. In India and Southeast Asia, we're tracking 5 separate drill ship programs planned, representing over 8 years of firm-term work combined.
8 years just in that region.
Yeah. It shows that while the Golden Triangle is critical for Deepwater, significant multi-year opportunities exist globally. It's also important to remember that long-term contracts are typically awarded at least 9 months before planned commencement, so we anticipate more high-value awards across the industry throughout the year as operators secure their drilling slots for 26 and beyond.
So expect more contract news.
Definitely.
That's a comprehensive view of the floater market, painting a very positive picture for Valaris's high-spec assets. Now, let's shift to the jackup market outlook. How is that segment performing, and are there any particular trends shaping it? A bit more varied, maybe.
It is a bit more varied regionally, yeah.
Yeah,
The global marketed jackup fleet utilization stood at a solid 90% at the end of Q1 2025.
90% is still pretty high, right?
It is robust, yeah. But it did dip slightly from 94% earlier in 2024. This slight reduction in global utilization has led to some downward pressure on day rates in certain benign environment regions, particularly where rigs are leaving Saudi Arabia and seeking new work, which creates a temporary oversupply in certain localized markets.
So some pressure in certain areas as rigs move around. But are there any markets that have remained resilient, perhaps due to Valaris's strong established positions, like you mentioned in Trinidad and Australia?
Absolutely. Key niche markets where Valaris operates, like Australia and Trinidad, have remained largely insulated from these dynamics. Day rates in these regions have held firm, typically in the mid to high $100,000.
Still strong rates there.
Yeah, demonstrating the value of established positions and specialized assets in these areas. The unique regulatory environments or specific project requirements in these markets often protect them from broader pricing pressures.
What about the North Sea, an important region for Valaris's harsh environment jackups? Is it facing similar competitive pressures?
The North Sea is experiencing increased competition due to an uptick in available units following some operators prioritizing activity in other basins. This might result in increased idle time across parts of the North Sea fleet.
Just a bit tougher there, maybe.
Potentially. However, Valaris rigs in the region benefit from strong contract coverage, and they're seeing new energy projects like plug and abandonment becoming a growing source of customer demand.
Ah, the P&A and new energy angle again.
Exactly. This new demand stream, separate from traditional exploration and production, is an area where Valaris rigs are very well positioned, leveraging their versatility and harsh environment capabilities. It helps offset some of the E&P slowdown.
And who are the primary customers for jackups? Are their drivers different from deepwater clients, perhaps influencing market stability? You mentioned NOCs earlier.
Yes, they often are. The largest customers for jackups are frequently national oil companies, or NOCs. Their drilling needs are driven by broader factors beyond just immediate project economics, such as funding national infrastructure projects, ensuring domestic energy security, and maintaining local employment.
So political and social factors matter too.
Right. This provides a stable and fundamental demand base for the jackup market, often less sensitive to short-term oil price fluctuations compared to purely commercially driven international oil companies. It adds a layer of resilience.
In a world that often feels unpredictable, with various geopolitical and economic factors at play, how is Valaris navigating these macroeconomic uncertainties? We've seen proposed tariffs, OPEC plus shifts. How do they factor these into their outlook? Are they worried?
Well, you're right. There has been increased macroeconomic uncertainty recently, stemming from proposed tariffs on international trade and the accelerated unwind of production cuts by OPEC plus C. However, Valaris is staying very close to its customers, engaging in constant dialogue.
Keeping lines of communication open.
Exactly. And while it's still early, scheduled programs and ongoing tenders largely appear to be on track. They haven't seen significant changes in customer behavior yet due to these broader macro trends.
So despite the external factors, they're maintaining their course, focusing on what they can control.
That seems to be the approach. Their focus remains squarely on what's within their control, delivering outstanding operational performance, executing their commercial strategy, and prudently managing their fleet and costs. This proactive and focused approach is key to their resilience in a volatile global energy landscape.
Makes sense. Control the controllables.
Pretty much. They understand the macro environment, but they are confident in their ability to secure work and operate efficiently, regardless of every minor headwind.
This deep dive wouldn't be complete without a closer look at Valaris's financial health and capital allocation strategy. Let's get into the specifics of their Q1 2025 financial review, seeing how all those operations translate into the ledger. How did the segments break down?
Certainly. As we discussed earlier, total revenues for Q1 2025 were a robust $621 million. Looking at the segments, floaters contributed $356 million in revenue, which was a significant increase from the previous quarter.
The floaters really drove the revenue beat then.
They did. This surge was primarily due to the Valaris DS-4 commencing a new high-value contract offshore Brazil, and the Valaris DS-15 starting a new higher day rate contract, even with the Valaris DS-12 completing a contract in Egypt. This demonstrates the immediate impact of securing those premium deepwater contracts.
And how did the jackup segment perform on the revenue side, given some of the market dynamics we discussed?
Jackup revenues were $186 million, a slight decrease from the prior quarter, mainly due to fewer operating days, including planned repairs for Valaris 249.
The rig repairs impacting revenue.
Right. However, this was partially offset by higher average daily revenues, indicating strong pricing for the work they did perform, suggesting that while some rigs had downtime, the active ones commanded excellent rates.
So rates held up.
Yeah. For ARO Drilling, their joint venture, revenues were $135 million, also a slight decrease, but maintaining a very stable contribution to the overall revenue picture.
What about their expense management? Did costs increase significantly with all the activity, or did they manage to keep a lid on things?
Well, for Valaris overall, contract drilling expense actually saw a positive trend, decreasing to $374 million from $381 million in the fourth quarter of 2024.
Expenses went down. How?
This was primarily due to a non-cash accrual in Q4 2024, which normalized in Q1, partially offset by higher floater costs as the Valaris DS-4 returned to work, incurring operational expenses again.
Okay, an accounting swing mostly.
Mostly, yeah. For jackups, expense increased slightly due to repair costs for Valaris 249, which was a necessary investment. ARO Drilling's expenses also increased, mainly due to higher bareboat charter expense. Importantly, general and administrative expenses decreased to $24 million, and other income increased to $11 million, partly from the strategic sale of the Valaris 75 jackup. Capital expenditures also decreased to $100 million due to timing of major projects. This all points to disciplined cost control and active portfolio management.
So healthy revenue growth, disciplined expense management, and strategic asset sales contributing to cash flow. How does all this translate into their overall cash flow generation and liquidity position? Are they building a strong financial cushion?
They show a very strong cash flow position. They generated $156 million of cash flow from operations in Q1.
$156 million from operations.
Yeah. And, as previously mentioned, $74 million in adjusted free cash flow, which demonstrates their ability to generate robust cash after accounting for capital expenditures and asset sales. This is a critical indicator of financial strength, showing they have capital readily available for strategic deployment.
And their cash reserves. How much financial flexibility do they really have to navigate any unexpected turns or seize opportunities? What's the war chest look like?
As of March 31, 2025, their cash and cash equivalents were a robust $454 million.
Almost $500 million in cash.
Right. And when you factor in their fully available revolving credit facility, their total liquidity stands at approximately $830 million.
$830 million total liquidity.
Yeah. This provides them with significant financial flexibility to not only navigate market dynamics, but also to proactively pursue new opportunities, whether that's further fleet optimization, strategic growth initiatives, or returning capital to shareholders. It's like having a deep reservoir of capital that allows them to be agile in a constantly shifting landscape.
That's a solid financial foundation. What about their forward guidance for Q2 and the full year 2025? Are they anticipating continued strength, or are there any headwinds on the horizon we should know about?
Okay, looking ahead. For Q2 2025, they expect total revenues to be in the range of $570 million to $590 million, and adjusted EBITDA between $140 million and $160 million.
So a slight dip expected in Q2 compared to Q1. Why is that?
The anticipated decrease in revenue for Q2 is due to a few factors. Planned idle time for Valaris DS-12 as it repositions for its next contract, lower amortized revenues for Valaris DS-17 as it completes its initial firm term, and out-of-service time for jackups undergoing 20-year surveys, like Valaris 106 and 248.
More planned downtime and contract roll-offs.
Exactly. However, this is expected to be partially offset by the Valaris 144 returning to full operation and Valaris 249 coming back online after repairs. Contract drilling expense is expected to decrease in Q2 to $395 million, $410 million, due to proactive cost reductions for idle rigs and capitalized costs for rigs undergoing major shipyard projects. G&A is expected to increase slightly to $28 million, but these are all manageable operational fluctuations.
And for the full year, are they maintaining confidence in their performance? Did they update the annual outlook?
They did. For the full year 2025, they've reiterated and importantly narrowed their adjusted EBITDA guidance range to $500 million to $560 million, reaffirming the $530 million midpoint.
Narrowing the range usually means more confidence, right?
It's a strong signal, yes. Increasing confidence in their financial performance and visibility into the year. Their total expected revenues of $2.15 billion to $2.25 billion for 2025 are nearly 99% contracted at the midpoint.
99% contracted for the whole year already.
Nearly, yeah. Which gives them exceptionally high visibility into future earnings, providing a very predictable revenue stream.
I understand their CapEx guidance was also adjusted upwards. Usually an increase in capital expenditure might raise an eyebrow. But what's the reason for that, and is it a positive sign in this case?
That's a great question, and in this case, it's actually a very positive development. Their full-year CapEx guidance was increased to $375 million to $415 million.
Why the increase?
This isn't due to unexpected overruns, but rather because shipyard days for ARO leased rigs are being pulled forward into Q4 2025 from 2026.
Pulling work forward. Why?
This move is directly driven by their recent contracting success, meaning they're investing to prepare rigs for new secured work sooner than anticipated. It's an investment to meet committed demand, which is excellent.
Spending money because they won contracts. Good problem to have.
Exactly. They also expect to receive $75 million in upfront customer payments this year, which will help offset these contract-specific upgrades, further demonstrating the collaborative nature of their client relationships.
And finally, a brief note on tariffs. This is a topic that can impact many global businesses. How are they managing those potential impacts? Is it a big concern?
Well, Valaris is taking proactive steps to mitigate tariff impacts. While their direct imports into the U.S. are small due to their international footprint and focus, they are actively addressing indirect impacts from U.S.-based suppliers who might face increased costs due to tariffs.
So managing the supply chain risk.
Right. They've stated that while the situation is fluid, their full-year guidance accounts for the potential impact of these tariffs, showcasing their active risk management and their focus on controlling what they can in an uncertain environment.
This sounds like a very intentional and disciplined approach to managing their capital, balancing investment with returns.
Yeah.
How do they think about that balance overall?
It absolutely is. Their capital allocation strategy is clearly value-driven and prudent. They are committed to maintaining a conservative balance sheet with low leverage, currently standing at a very healthy 1.1x net leverage, and have robust liquidity of approximately $830 million, as we noted.
Low debt, lots of cash.
Exactly. This strong financial position allows them significant flexibility to not only reinvest in their fleet, but also to return value to shareholders.
And what's their philosophy on returning value to shareholders? In an industry that's often capital intensive, it's a key indicator for investors, isn't it? What do they do with the cash?
Yeah, it's crucial. They've stated their clear intention to return all future free cash flow to shareholders unless there's a more value-accretive use for that capital, like a significant, strategically compelling investment or acquisition.
So return cash, unless there's a really good reason not to.
That's the message. They've already returned a substantial $325 million to shareholders since the start of their share repurchase program in 2023.
$325 million back to shareholders already.
Yeah, which is a strong signal of their financial discipline, confidence in their cash generation, and clear focus on shareholder value. It's a testament to their belief in the long-term health of their business.
So, as we wrap up this deep dive into Valaris, our crystal ball has truly cleared, wouldn't you say? Showing us a company not just surviving, but thriving in the complex, demanding world of offshore drilling.
Indeed, I think that's fair. From their state-of-the-art seventh-generation drill ships pushing the boundaries of deepwater exploration to their versatile jackup fleets serving critical shallow water markets, Valaris is consistently delivering.
Right.
Their impressive and growing contract backlog, their stellar safety record that outperforms peers, and their robust financial performance all paint a picture of a company with a clear vision and strong execution, actively shaping the energy future.
We've discussed how offshore production, especially deepwater, remains a critical component of global energy supply. It offers compelling economics, even in uncertain times. And Valaris' strategic approach to fleet management and securing these long-term contracts positions them not just for today's energy demands, but for decades to come, providing a clearer vision for a stable and reliable energy future.
Yeah, they are continuously adapting, optimizing their fleet, and demonstrating an unwavering commitment to operational excellence in a foundational industry.
It's a fascinating example of how a company in a foundational industry is evolving to meet future challenges, leveraging technology, strategic partnerships, and disciplined financial management to maintain its leadership position.
Absolutely. It really highlights the dynamism even in established sectors.
And that leads us to a final provocative thought for you, our listener, to mull over. Considering Valaris's consistent operational excellence as strategic investments in these high-specification rigs, what further innovations might emerge from the deepwater drilling sector to maintain its economic viability and environmental efficiency in an ever-evolving global energy landscape?
Good question.
And how might these advancements redefine what's truly possible beneath the waves? Something to think about.